underlying equity market is to gain exposure without having to actually fund or buy the underlying physical securities. So generally, they're predominantly used from a hedging strategy or to gain exposure, rebalance our portfolio. Still can be seen as a risk reducing strategy, but in many cases you're used as speculative because again, you don't have to buy the physical asset itself. You can take a leverage position and use these futures to bet on a certain direction, both long or short, up or down, depending on your views of what the market is going to do. Why do we generally use derivatives in portfolio management? They tend to be less expensive than trading physicals, and in many cases, you don't have liquidity issues that you may have with the underlying securities. It does give you a huge amount of flexibility, both being able to shift asset classes either daily or by the minute, by the hour, if we need to. But really, it allows you to adjust your asset class exposure, do rebalancing strategies without actually having to go through the bother and expense of trading or adjusting the underlying physical securities. And I'll show some of the mechanics as we go through today. Equally, it can also help you without having to adjust your portfolio, provide some downside protection by using these to hedge or take off some of your risky positions depending on what the market strategy is doing. Again, it does tend to be very liquid and easily traded. So the speed is an important aspect that allows you to go to the market and adjust your entire portfolio or your entire asset class quite quickly without having to go and trade multiple securities. So going into a little bit of the mechanics of how we do this and how we do it, we look at derivatives. You can obtain these equity exposure either physically. So this is an example of how we would do it physically. You have your cash that you plan to invest in the markets, and you would buy physical securities via an exchange or via a broker. In this case, we're using an example of the NGX30 index fund. You would go and buy all underlying securities in their appropriate weight in the NGX30 index. And what the return gives you is the standard return, basically CAPM, which is the market risk premium, to use an extreme example, 6% in this case, plus a risk-free rate, in essence, what the cash is, or the underlying risk-free government securities rate is. In this case, for example, we're just using that 2%. So your total return of 8% comes from a combination of market risk premium and the risk-free rate, which you get from the underlying physical securities. Now, how do we do this via futures, and how are they linked? In essence, you're taking that 100 million Naira cash in this case, and we are putting on an overlay, a futures overlay, or buying long NGX30 futures in this case, use example, for 100 million. Now, obviously, because you're not physically purchasing the security, what you get with the futures is that market risk premium, in this case, 6%, to match the previous slide as we were discussing. Now, where does the risk-free rate come into play in this one? It's that 100 million that you retain, for the most part, in cash or put it in government securities to give you that risk-free rate 2%. So the combination of the futures giving you that 6% risk premium plus the underlying cash, which is giving you that risk-free rate, equates using a futures overlay with the physical purchase of the securities. Now, this can be reversed as well, giving you synthetic cash. So in this case, if we look at the return, basically swapping these boxes, if you will, and we look on the left side, the return, that 8% that we spoke of before, where you get the market risk premium, 6%, and the risk-free rate, as if I was purchasing those physical securities. If I short or sell, in essence, the NGX30 futures, in this case, I'm removing that risk premium that we saw on the previous slide and giving the portfolio just that risk-free rate or synthetic cash, if you will, because I obviously still hold the physicals, but with the derivative exposure, I'm taking that market exposure off of the table, giving me the risk-free rate. And this is why derivatives in this case can be so flexible. I can actually add long or short to take risk off the table while still holding the underlying securities, or in the previous example, if I don't want to hold the underlying as well, I can replicate that market exposure. So it adds that flexibility, and it does tend to add speed because it is quite liquid in the market. However, there are some differences when we're talking about derivatives versus the physicals, because you do have to have this cash backing, not all of it, hence the leverage, which we'll talk about a little bit more shortly, but you do have to have some cash, and that cash is mostly combined of an initial margin and initial collateral that you need in order to put the position on, depending on the riskiness of the position and depending on whether you're a hedger or speculator, that value does tend to change. But basically, you have to have an initial margin that stays in the account, a collateral amount. In many cases, however, the collateral amount can be government risk-free fixed income securities, which helps the cash liquidity position. But there does have to be an element of cash for margin, because any daily gain loss has to be paid in or out of the account, and that needs to be done with cash. The advantage is if you have the entire value in cash to back your position, that amount should be and can be invested to earn you interest, hence that risk-free rate of return in the previous calculations. And then that cash is, again, overlaid with the index futures. With listed futures, especially, these positions are, as they call it, mark to market daily, where any gains come into the account and any losses come out of the account, hence the cash position. But that also reduces the risk, because there isn't any long outstanding gain or loss either from the asset owner or from the counterpart, in this case the exchange, to have that credit risk. So it's a great advantage as well. There isn't a long-term risk position or a credit position we have to worry about with our counterpart. This margin can move up or down, and generally what happens is our broker counterpart will request certain cash, a certain amount, to be replenished should that balance drop a little bit further than we expect. What are some of the cost components when we're talking about futures? We mentioned it's a relatively inexpensive alternative to listing. We do have explicit costs, which are commission, which you would experience whether you're trading on the physical side or the derivative side, which includes execution, clearing, etc. But there are implicit costs, again, similarly to if we are purchasing these on the physical side. You do have a bid-ask spread. Again, the advantage of derivatives is it tends to be relatively small and relatively tight, given the liquidity of the positions. But we do have such things as market impact and opportunity cost. Market impact being that if we're trading a relatively large position, given the liquidity and market exposure of the positions in the market, we may drive the market adversely if we're trading in a large position, and that's the market impact. But that also goes into our trading strategy and how we do want to trade these positions. Opportunity cost really just comes down to timing. When am I getting in or out of these positions at the open, at the close, during the day? And a lot of that is going to depend on our benchmark. Are we benchmarked throughout the end of the day, or a benchmark volume weighted average price, etc.? But these are some of the implicit costs that are going to affect our performance or our tracking against the underlying index. Now, futures, of course, are not without risk. They tend to, in some cases, be a little bit different than if you're trading over the counter on an exchange. What you eliminate with exchange is that credit or counterparty risk, that you don't have to worry about a counterparty making you whole in some cases, but there is still risk. The listed futures are collateralized, which helps that. So your money is put forward to be able to cover the gain loss, reducing that. And it is, in that sense, a similar risk to the underlying physical, where you have market risk. The price of the underlying is going to affect the price. And the difference is that if you are significantly leveraged, in other words, you are trading or have exposure to dramatically more in amount than you have underlying cash backing it, that could run into some risky positions. When the market moves, it is just multiplied of the effect on your portfolio, but it can be managed, as we will see shortly as well. But economically, the impact of holding stocks should be equivalent in a perfect world. So for using the example we see here on the slide, if you have 100 million in an index fund and that drops down 10%, your value of your portfolio is 90 million. Now, granted, this is unrealized and it is a paper value until those securities are liquidated, but the value itself, if that 100 million drops by 10%, goes down to 90 million. Similarly, if you're holding the cash and you purchase the futures to give you that market exposure, you have that 100 million in cash plus futures, and if the market drops 10%, 10 million of that cash has to be paid back out of your collateral, out of your margin. And so the value of your cash backing those futures is 90 million. So the equivalent is 90 million in portfolio value, there'll be it unrealized, or 90 million in cash. The impact, given the market movement, should be equivalent, ceteris paribus. So what are some of the pros and cons, again, of using the futures? The index futures does give you a hedge against decline in similar holdings, because you can take positions, you can take equity exposure off of the table, if you will, by not having to sell your actual physicals and realize those costs. You can just remove some of that exposure if we're concerned about adverse marketing conditions. It's easy to get into, and in fact, the brokerage accounts only require a fraction, as we saw, the initial margin and the collateral. So even if you don't have the entire, to use the previous example, the 100 million to invest, you only have to put anywhere from 10 to 15 to 20% of the value that you're interested in investing into a collateral amount or collateral account, to take on the positions. And so it also allows you to bet or take speculation on the index price movement. I have a feeling in the next few months that the market's going to go up for a relatively small amount. I can go ahead and take a bet on that market and take advantage if my call is correct. Some of the cons, however, are wrong direction hedges can damage portfolio gains. We may want to be taking market exposure off the table, but if we call it wrong, we are missing out on those gains we would otherwise hold. But equally, the similar situation could be if we sold our underlying physical. The brokers can demand additional funds to maintain the account, and this is where the collateral situation comes into play. You have to have that cash or some liquid securities to back that should the markets move against you, to be able to fund that brokerage account, or your positions can be closed out by the brokers. It can be a high risk undertaking, especially if you're speculating and using that in a leverage standpoint. So for example, I have 15 million, but I want to get 100 million in exposure. If the market moves against you, you're taking a pretty highly leveraged position, and you have to have cash to back that. And it can be, your position in the market can be multiple times what you're actually holding underneath in cash, which can be a significant risk. And of course, unforeseen factors. There could be various liquidity items. There could be shock market movements that may have an effect on your cash visualization or your underlying liquidity. So one of the things, very specifically, what are some of the things that can go wrong? Unintentional leverage. So if you have the 100 million cash and you're overlaid with 105 million in futures based on the way the market moved against you, you're actually leveraged in this case by 5 million. That can be a problem. So you have to go each trading day and make sure the cash you have backing your position, cash or other physicals, is equal to the amount of market exposure you have. In essence, be dollar neutral. And that's something in proper portfolio management can be monitored on a daily basis. Now, you do have operational errors or trading errors that can affect your position. Either there's a poor execution at the wrong time of day, or a wrong direction, you want to buy versus sell, etc. And then obviously the collateral management and margin maintenance process has to be maintained, and it has to be managed very, very quickly, very, very importantly, and very, very exactly, to make sure you're not over collateralized, under collateralized, and the proper amount is available to go back and forth, giving your gains and losses. The controller over this and how do we control these risks is really the experience, and getting a proper trading desk, getting proper systems and procedures to make sure the value of your portfolio is correct, the calculation on the daily margin variation is correct, and the money is moving in the proper ways. And then again, we have tracking error, which we'll again go into shortly to see why tracking error is an issue. It's when the futures contract or the basket of securities that I want to hold to mimic or replicate the physical exposure does not match exactly what my target exposure is or my target index is. And how you control that is trying to use either optimization tools or use really strong diligence when you're opening and closing your positions to make sure you match as closely as possible to the underlying physical exposure you are trying to replicate. So very briefly now, I want you to go into how this is used in portfolio management. You can use it as cash overlay or liquidity management. Again, as we mentioned before, trading that in lieu of physicals because it gives you the speed and trading cost advantage. You can get into the markets rather quickly and rather cheaply and do short-term rebalancing to your portfolio, again, without having to trade the underlying, which can get quite expensive at times. So there are different ways to do rebalancing and strategic hedging based on your views in the market, and it gives you that speed advantage to both enhance your return or reduce your risk. So how do I do this from a cash equitization standpoint? Cash equitization really is a strategy to make sure your portfolio is getting your maximum exposure in the market. Generally, when we're looking at portfolios, there's always going to be a portion of cash, either if you're a professional fund manager, to make sure you have sufficient cash for subscriptions, redemptions. There could be dividends that come in, interest pay that comes in, and that sits in cash. And that actually is dampening some of the return or alpha you have. So what do we do with this cash? What you can do is take that cash and overlay that portion of cash with derivatives, with futures that mimic your underlying desired market risk exposure so that the entire portfolio is getting you that market risk premium. That still allows you to have the flexibility for capital calls, distributions, payments, etc., but your entire portfolio is getting that market risk premium, which we all desire when we invest. Equally, when we're doing asset allocation shifts, usually on the physical side, it takes a significant amount of time, either time to trade our underlying physical securities, or if we're looking at shifting, say, a manager in a bigger portfolio or shifting asset class, that's going to take some time to contract, find the right managers, take the money and get it into place. And that can take, and sometimes months, and that will shift and go away from when we have made this asset allocation decision. Derivatives allow you to go long or short the different asset classes in our current portfolio to make sure we are getting the desired portfolio, and we can do that immediately, giving us that asset allocation that we have calculated, studied, and want to implement immediately. And then we can take our time to do it on the physical side and then unwind the derivatives at the same time so that our desired asset allocation is maintained at all times. And how does this type of rebalancing work if we're looking at either asset allocation shifts or rebalancing? We have our desired benchmark weight. Our physical security weight can change from that. If you let's use an extreme example of the 60-40 portfolio many of us are familiar with, just due to market movements, we can be at, say, 65-35. The physicals are different than our benchmark weight. We can use a futures position very cheaply and quickly to remove that additional 5% of physical security weight that is greater than what we wanted with our asset allocation. And then if the market changes, we can unwind that position, giving us the exact position we want. And this can change. You can combine a cash overlay and a rebalancing strategy to make sure your entire portfolio is exactly at that benchmark asset allocation or benchmark weight we desire. We can do that cheaply. We can do that effectively and quickly going to market. Now, very briefly, I talked about tracking error and what that means for us if we're looking at derivative basket instruction. We're using an extreme example here of using a global market. And although physically we would own all the securities in a global benchmark such as MSCI or S&P Global or something of that nature, not all markets have derivatives, and not all the derivatives are going to be based on the desired underlying index, MSCI, S&P, what have you. So you do have to have a basket representing as much as we can and as close as we can to match the beta of the underlying, in this case, using a basket of securities as we see the OMX in Sweden, MIB in Italy, IBEX in Spain, et cetera, et cetera. And we use optimizers and tracking tools to make sure the beta is as closely as possible. It's never going to be a perfect match, but it is a fantastic solution to gain our underlying market exposure. In some cases, you're using a combination. So for example, if you're using the well-known Russell 3000 broad US market index, you'd use a combination of S&P 500 to get the large cap and Russell 2000 to get the small cap. And it really gets us the majority of the way when it comes to managing beta. So with that, I'm happy to take some questions. And if there is further educational support that anybody is interested in, the CFA Institute, both from the Institute side or your incredible partners at CFA Institute Society of Nigeria can help you with learning, certificates, charter information, and research to provide additional information and insight into using derivatives. And with that, I will stop and happy to take any questions if we have some time.
Thank you very much, Klaus, for that comprehensive presentation. And I think we have one question from Patrick. And just a reminder to everyone that if you have any questions, you could either click on the raise hands button or type in the chat box. So he says, given the current wandering nature / high uncertainty of the Nigerian economy, what best strategy can the futures trader adopt? Patrick, so just a reminder that we would be having a session, a panelist session with seasoned experts that have, a variety of experiences in the asset management industry in Nigeria. And I believe these professionals would be better equipped to answer this question. But Klaus, if you have,
Sure.
have 1 or 2 comments to
absolutely.
say on this question.
I can be very brief, and then obviously, yes, the experts will be good. But in this case, given the wandering nature, the high uncertainty, and the volatility, derivatives can be a bit of a struggle when we have these type of markets, because what's going to happen is you're going to see huge swings in cash to have the variation margin go back and forth on this case. What I would suggest in these type of economies and uncertain natures, make sure there is a significant amount of liquidity and a significant amount of cash backing your position. So for example, if I have 100 million Naira portfolio or exposure that I want to get, but I have the backing of that in some relatively illiquid equities or fixed income securities, it's going to be a struggle if the market swings both back and forth. So what I would suggest is probably to keep at least half of my backing securities, whether that's cash or fixed income, in very, very liquid assets to be able to maintain that collateral or market variation position on that one. And that's the best way. So in other words, avoid a lot of this leverage and speculation, especially with illiquid securities backing it. That's what I would suggest.
Thank you, Klaus. I think there are a few more questions coming in. So how often do you use spreads? This is a very straightforward question from Apolabi.
How often do you use spreads? Not quite sure that. I mean, spreads basically, when we're talking about market spreads, every trade has a spread component to it. But generally, when you have times where there's a lot of liquidity in the market, that spread is very, very narrow. That's the advantage of using a lot of derivatives. The spreads tend to be a lot smaller than if you're using the physical securities, because you're looking at buying individual securities, which can have a high spread on them.
Thanks for that. A few more questions.
Sure.
As the equities markets fluctuate a lot, how can derivatives be used to hedge against market risk exposures, either equities or fixed income?
Absolutely, and I think that's one of the great advantages of derivatives. If we don't want to take off our underlying physical exposure, which can be very expensive, what you can do right from the start, and what I don't have in this presentation, and I'm happy to go into it another time or have a discussion, is downside protection strategies using derivatives. And what you can do is, depending on how you want to calculate it, either quantitatively or using your own intuition, is take a significant amount of the equity exposure off. So for example, let's just use that 100 million Naira example that I may have in equities. What I would want to do perhaps is short, using listed futures, about 25% or so, depending on the nature of the volatility, off of that position. So in essence, I'm only exposed 75%, say, to the market, but that can be adjusted very quickly and very easily. And that's fixed income or equities, depending on the derivatives available to do it. So in this case, when when markets are fluctuating, it probably is a good opportunity to offset or short some of your listed equity position by shorting derivatives. And if the market drops, then you absolutely take advantage. So that's one of the great thing is there is huge advantages with shorting activity with derivatives. And then I see one more question. I probably realize I'm out of time for that, but why would an investor want to short a future contract to earn a risk-free rate when he can easily invest in a sovereign instrument? Absolutely. And why would you want to do that? It really is for a short-term speculation where you would not want to remove your underlying physical securities. If for long-term you want to invest in a sovereign instrument and long-term get that market return, absolutely invest it in the physicals. It's a much better way to do that. But in the case of the example I used and where you would do that with derivatives, it's a temporary view on the market where you want to remove your equity exposure and you get that risk-free rate without having to sell your underlying physicals. I see there's other questions, but Fola, do I have time, or should we end it there?
I think we still have time for one or two more. Okay. So you could take them, please.
Fantastic. Why should I trade on derivative using margin instead of investing directly in the underlying? It can be risky due to margin call. Absolutely. It really depends on what your trading strategy is. Now, for the most part, if you're a long-term investor and you're investing in this strategy for a significant position or for a strategic position, absolutely, I think the physicals are the best way to do that for a long-term strategy. Where derivatives are really useful is if you're making short-term or relatively short-term adjustments to your portfolio or take short-term views on the market. So for example, my view in the next 6 weeks, 2 months, or we're going to have a positive view of the market, I'm going to enter derivatives because it's a much quicker way to do it. It's a less cost-effective, or it's a more cost-effective way to enter the markets, knowing that I might remove that position in a relatively short amount of time. It is risky due to the margin call, and that's why it's very, very important to have the funds, as I mentioned in the earlier question, to back the derivatives, especially in times of high volatility. But equally, for the most part, the way I've used derivatives in my career and for a lot of the larger pension schemes and investment strategies that I did, we have the underlying either cash or liquid securities, government fixed income securities in this case, backing the position. So the risk is reduced because I actually have the funds behind it and I'm not taking a large leveraged position. So again, to answer the question, derivatives are great to use mostly for relatively short-term adjustments or adjustments on the fringe or outside of our portfolio. But if you're a long-term strategy to go into equities or certain asset classes, it is best to go into the physical security in that case and hold that. You get the benefit of dividends, you get the benefit of not having to have the liquidity and cash backing.
Thank you very much, Klaus, for that insightful presentation once again. So I think we would stop here. If you have any questions, maybe you could be answered in the chat box. But for now, we'll move on to our next session. But just a reminder that this event is being live streamed on YouTube. So if you miss something out from Klaus's presentation, you can always go back to play. So with me this morning are 3 financial markets experts who will engage in what promises to be an insightful session. I would start by introducing our first panelist, who goes by the name of Laura Fisayo-Kayode. She is the Senior Vice President and Head of Equities Head of Equities and Alternative Solutions from FBNQuest Asset Management. She is dedicated to building and developing a sustainable investment management business, offering clients the opportunity to invest at home and abroad. She started her career at Barclays Wealth and Investment Management in the UK as a portfolio manager, and she has managed over 1.5 billion in multi-asset portfolios. She currently manages a team of buy-side research analysts and portfolio managers, and also performance analysts in FBNQuest. Next with me today is Dr. Peter Onyango, who is the Principal Specialist, Risk and Stress Testing at the Capital Markets Authority in Kenya. Dr. Onyango has been instrumental in the establishment of the exchange-traded derivatives markets in Kenya. So his presence here on this platform is extremely valuable. He previously worked with KCB Bank Group as the Regional Market Risk Manager. He studied his first degree in actuarial science and had a master's in finance from Strathclyde University in the UK. He also holds a doctorate in business administration at the United States International University. He's a full member of the Chartered Institute of Securities in the UK. Lastly, I have with me Pabina Yinkere, who is the Chief Investment Officer at Sigma Pensions, a Tier 1 pension administrator in Nigeria with over $1.4 billion in AUM. His role involves articulating and executing the investment strategies for 15 public and private funds under management. Pabina has over 17 years experience in investment advisory, institutional research, financial strategy, and portfolio management. Before joining Sigma, Pabina worked in various capacities at Vertiva Capital Management, where he was part of a team that introduced ETFs to the Nigerian market. He holds an executive MBA from Lagos Business School. I'd like to thank all of you for taking your time out to be here today. And just to everyone out there listening, there will be opportunities for Q&A out after the session, and you can also type your questions in the chat box as we have done before. So perhaps we can start with you, Peter, giving your strong exposure to the derivatives market in Kenya. So derivatives is a relatively new and, should I say, unfamiliar product within the Nigerian market. It's therefore difficult to know how or what to expect when it comes to its application. So there are questions about how well derivatives will be received, its level of sophistication, the cost of implementing derivative strategies, and also doing all this while trying to comply with regulation. So can you just describe how the journey has been so far since Kenya's derivatives market kicked off a few years ago? And how would you say the market has been responding to derivative offerings? Your mic is muted.
Oh, okay, thank you. So in Kenya, derivatives market began around 2009, and it was a serious government project, including the government and also the Nairobi Securities Exchange coming together and deciding to make it happen. So currently, the market has 10 futures contracts based on the most actively traded shares, equities, and also there are 2 contracts based on indices that are existing. So in terms of the one contract would be, an example would be Safaricom, which everyone knows M-Pesa. And one that is one of the contracts that are being have been made into a derivative. So there's been, since 2019, there's been good growth. In terms of, we started with around 500 contracts in 2019. Now there are over 10,000 contracts that are trading every year. Of course, it's still not hasn't exploded into what it wanted to be, but it's still a good thing to note that Kenya is the second market in Africa that has derivatives, and now, of course, now we have Nigeria as the third. So, in terms of the journey, there was a regulation that was done. That regulation was done together with stakeholders at the government. Once it was implemented, now it was up to the Nairobi Securities Exchange to set up the market. There was a lot of benchmarking that happened because, this African market is different from the European markets. So we benchmarked with India and South Africa at that time. So with that in mind, once it was launched in two ways. There was a phased approach, so that there can be some learnings to be done. Because even generally the country was spooked around the word derivative. So it was agreed that we can have it in phases. First, have a small launch, see how the market will run, and then make a wider launch, which happened. What we learned as we continue engaging is that high net worth individuals and retail is actually what drives our market right now. And I think the same thing also happened in M-Pesa, where now it is all about retail investors that brought it in, and then now corporates are coming in sooner than later. The next biggest issue with us in Kenya was liquidity, because you may find someone who wants to do a short position and there's no one available to do a long position. With that in mind, it was decided to have someone to do liquidity management, kind of to have a market maker. So the exchange partnered with one of the brokers, the best broker that existed, and gave them the mandate to provide liquidity, which actually helped grow the volumes and increase confidence in the market. The biggest thing is to be responsive to market needs when designing and introducing new products. A good example is, as I explained before, we had two indices that have been made into futures contracts. The first one is NSE 25 share index, which was found to be too expensive to buy. So because the market was insisting that they wanted something cheaper, we introduced a contract called the mini NSE 25 share index. So the mini index has much fewer counters in it, which made the contract cheaper. So the example of always being responsive to market needs and developing products around that. Thank you.
Great, thank you for that set of response. I mean, it's quite encouraging to see that the market has gone from just 500 contracts to hundreds of thousands of contracts, and it's also interesting to see that a market that was in quotes spooked by derivatives has seen an increase in confidence, and I guess that's something positive for us. I mean, if we continue to look at the direction Kenya is taking, I guess it's encouraging for the Nigerian market, and at some point it's hoped that HNIs and retail participants would drive this market, which is not being seen in Nigeria. It's the other way around for the traditional markets. So I would like to move on to Laura and bring things home. So Laura, as a portfolio manager overseeing large-sized equity and alternative investment allocations, what type of challenges do you currently face as you aim to maximize returns and minimize risks within the funds that you manage? And how can derivatives alleviate this kind of challenges?
Hi, good morning, everyone, and thank you for joining us. So, when Klaus was speaking, I think I was taking furious notes, right? And one of the great benefits of derivatives for me, when I think about it, is on the one hand, leveraging a portfolio, but on the other hand, risk management, right? Now, markets like ours are very volatile, and I think this year maybe shows that more than ever. And we have our asset prices moving in generally large and quite vicious swings. And what you find is derivatives allow you a cost-effective way, right, to get access to various markets, but also to hedge your exposures and protect your portfolios. So for example, if we take this year, as I said earlier, markets have been very, very bearish. We've had asset prices falling fast and very far. Now, the plain vanilla method, if you are an equity manager, for example, in a market like this, would be to sell the assets that you think will lose value. So if we use equities, as I said, it would mean selling some equities to protect yourself. But what derivatives allow you to do is to get that same exposure, because you can, for example, you can buy a put option, and that would allow you to pay a small premium, right, upfront, but you have locked in a sell price for your underlying asset in the future. So that gives you protection from price declines, but it also allows you to hold on to your underlying exposure. When Klaus was speaking, he talked about sometimes trading your underlying can be quite expensive. And we know that here locally to be a big issue, transaction costs. You know, if you sell your underlying exposure, you no longer have access to things like dividends. And frankly, you don't have any protection if things don't pan out the way you're expecting. And what derivatives allow you to do is to essentially have sold your underlying exposure without actually selling your underlying exposure. Of course, if things go the way you think, if prices fall, then you lose money on the underlying, but you make money on the put because it rises in value. Now, if things go the other way, right, and asset prices move up, then you make money on the underlying and you lose money on the put. Now, of course, you'll make more money, to be honest, without paying for the derivative if prices move higher. But if they move against you, you limit your losses, and that is a very valuable position to be in, especially in a year like this one. As I said earlier, I think I was making lots of notes when he was talking, and Klaus also talked about using derivatives to take exposures in markets very quickly whilst you build your underlying position. So for example, again, our market, is a great example where you want to take a position in a stock. Say you want to buy 500 million naira of a stock and pick a stock. The underlying stocks in the index are not always liquid enough for you to buy the amount you want to buy easily and quickly, but you can use derivatives. You can buy a call option or a future on that stock today, and you can bypass your immediate liquidity issue, and then you can build your position gradually over time and unwind your derivatives position. So, as he was speaking, all I was doing was just writing, like, these are the ways that you can use these instruments to really improve your portfolio management and to really give you flexibility when managing portfolios. And that really is what derivatives are there for. Thanks.
Thanks, Laura. And I guess derivatives are quite useful to you in particular, due to your funds, given the underlying volatility and the assets that are heavily weighted towards more of the riskier side. So that's
Exactly.
quite appreciated. And one thing I could pick out from all the things you said is the importance of derivatives with liquidity, because the challenge we have in our markets, particularly for some of these stocks, is liquidity. We only have a few stocks driving the movement of the NSE index. So thanks for that. So I'll move over to Pabina, and so just looking at your exposure in the PFA space, the challenge that we've had is that the participation of investors are more professional investors, and that means that market cap to GDP lags a lot of countries. We haven't really seen, there are professional corporates that are driving liquidity, but the challenge is that we haven't really seen the retail and the HNI is driving liquidity like Kenya. So do you think the derivatives market would play a role in helping to resolve this problem and create some sort of innovation that will bring more participants into the market?
Thank you, Fola, and thank you for having me. It's a pleasure to be here. One of the challenges we have in our market is liquidity. And like you have said, using that metric, market cap to GDP, you find that Nigeria's figure is quite low compared to the world. Nigeria's market cap to GDP is around 13% of GDP. If you compare that with what we have globally, the global average is around 134. But of course, there are lots of outliers out there. But if we even compare it with nearer home and look at South Africa, the market cap to GDP is over 300%. So it goes to speak to why you find the kind of shallow and lack of depth you have in our market. Part of those reasons could be because the market is not fully representative of what you have in the economy. It could also be the largely informal nature of the Nigerian economy. Then you don't get a lot of companies being listed on the stock exchange. So a myriad of factors coming in there to affect liquidity. But one of the things, and if you flow through what Klaus and then Laura have said, is that derivatives can provide benefits for investors, right? And part of that benefit is that it enables people to hedge risk, to speculate, things that would require that a lot more activity happen in the market. So in a sense, derivatives can be a channel towards improving market liquidity, if you look at it that way. One of the reasons why you would find that retail participation and even institutional participation is not so great in the Nigerian market is that the market is not liquid enough. For example, like Laura highlighted earlier, if you wanted to take, if you see what's happened this year, we've been through quite some volatility. And if you wanted to sell a position now, sometimes as an institutional investor, it can take you quite a number of days to get out of a position because of that shallow market depth. Derivatives, when they become prevalent in our market, can be a source for improving liquidity. And like Laura and Klaus even mentioned, because of the fact that for a fraction of the capital, you can gain access to what you would have gotten if you were doing an outright purchase. It provides the opportunity for people to leverage, and that also helps market liquidity. But one of the things I would like to point out is that as long as you can identify what the benefits of having a derivative is to a market, how portfolio managers can use it, it's not a big play for retail investors, but if it becomes an opportunity, if the market becomes deeper, then you might also have that attraction for retail players as well. If you look at our markets today, there's practically no option with which people can hedge risk, and that is a problem. But speaking to this, one of the developments we are having lately is that the NGX has just launched the equity index futures. So what these futures look at, it has developed contracts for the NGX 30 index and then the NGX pension index, which are two of the very widely used indices in our market. Also, the FMDQ, which is the country's premier fixed income exchange, is in the process of launching a bond futures contract. So by the time we have these things becoming more prevalent and investors are able to use them, it then creates a different dynamic in our market and create that depth that we seriously look out for. But one of the things I must mention is that beyond just having a derivative market, like any new product, it needs time to build. And in closing, I would just like to share some of the experiences we had in my previous life when we launched a new product, though not derivative, but still new products into the market, ETFs, exchange traded funds. It took a while to get going. For a start, many investors didn't even know what an ETF is, how it works, how to use them. So a lot of investor education needed to happen. A lot of patience was needed to happen, even from the issuer and product developer side. But eventually, when they became useful, we found them very, very handy. For example, in the year 2020, when we had COVID, one of the instruments we used to sort of like hedge our overall portfolios was taking positions in new gold. In that year, gold performed strongly. If you bring in the performance of the currency into that as well, you find that you have quite healthy returns to use to cushion any downside that one faced during that COVID period. So new products need time to breathe, they need time to grow, they need time to have a life of themselves. And I think we should, but what is key, what is very, very key in driving home this point and to the question you have made is that investor education needs to really, really happen. Thank you.
All right, thanks, Habina. So I mean, if I could summarize it in one word, it's we need more sensitization, or in a few words, actually, we need sensitization, we need education, and I guess your experience with the ETFs is quite encouraging, because I remember at that point as well, a few of my colleagues did not even understand what they were, and you know, but the market has evolved now. There are people having conversation around it, and you know, even using it to hedge, like you mentioned. So that's quite encouraging. I'd like to come back to you, Dr. Onyango. So still on Kenya. The question now is, what sort of challenges are you experiencing in attempting to further drive penetration? You mentioned that the derivatives market in Kenya still lags a lot of other markets. So what sort of other challenges are you seeing? Are there any lessons that you can extract from the rollout of derivatives in Kenya? And lastly, what could have been done differently to strengthen the market than what it is right now?
Thank you so much. For the Kenyan market, which I'm glad that Nigerian market is, I seem to see that it is being driven by the market players, because this is an event that has been brought by the CFA Institute. For the Kenyan market, I think there's a way in which the pension industry did not really get into the bandwagon too much. That's why I'm saying we are growing our market with the retail and high net worth. So there's a need for the pension industry in Kenya to look at it as a hedging product, which would have really helped in their portfolios during the COVID time. Now we even have the Ukraine issue happening in this world. So it would be a good idea if we could go back and see how maybe we could have included the pension industry at an earlier stage and hope that they drive the market. The other thing is maybe even the type of product. We did, I remember for us, we did a survey, and we found that most Kenyans were looking into futures contracts, which the underlying is currency and interest rates. So that at that time, it was not easy to launch because, of course, there were fears around the currency fluctuations and also the interest rate fluctuations by our central bank and other bigger players. So we ended up launching the equities futures contracts. But if we could go back into time, I think those two contracts would have, for our market, that is where our appetite was at that time. So those are the two main things that maybe if you could go back, maybe we could see how we could have done better. But currently, there's a lot of continuous education, trying to market the product and creating awareness to all sectors is one of the most important things to do. We have a lot of initiatives in which you can try and talk to the pension schemes to open up the investment policy documents to include pension, to include derivatives, which thank God it has happened. We talked to the pension regulator to allow the pension industry to do the same, which is also has been done. So for us, we're seeing a major growth in derivatives. From now on, I hope you can invite us once again, maybe next year, and I can give you a bit more positive feedback about what's happening in Kenya. Thank you.
Thanks, Peter. I'd like to come back to you, Pabina, while we are still on the subject of education and challenges within the derivatives and the broader markets in particular. So Babina, in what way do you think we can apply derivatives to enhance portfolio management, particularly in the pension space? Because you've been in the pension space for a while now, so your insights will be very, very valuable. And in this regard, do you envisage any challenge with back office functions such as marking to market, maybe documentation and aligning with the regulator? I know that the industry is heavily regulated, so if you could just speak on all this. Thank you.
Okay, so if you look at the pension industry today, industry asset allocation, you'll find that about 70% of pension assets is weighted towards FGN securities, largely federal government bonds and then treasury bills. Majority of it is being held to maturity. Some part of it is marked to market. But what you find is that for us, we are unable to hedge against market movement. For example, if you're going to have interest rates rising, there's pretty much no interest to hedge with. So it does provide a concern, and I think having something such as a bond futures contract can help you hedge against interest rates movements. Thankfully, the FMDQ is coming up with that product. But I think the more important thing to dwell on is, if you look at the Pension Reform Act today, it does not explicitly provide any exposure or allocation to derivatives. And because of that, what it means is that if derivative products are available in the market today, PFAs will not immediately be able to invest in it. However, a lot of discussion is ongoing. A lot of discussions around with product developers, with the exchanges, with our regulator to try and understand how derivatives can fit into portfolio management in pension funds, and to provide the benefits that you would get from that. But then again, one must also balance it with because when you think derivatives, the first thing people think is speculation, and then the risk management bit comes into it. But then you want to balance that out with how the construct of pension funds are, where one of the primary objectives is safety of funds. So a lot of careful understudy, a lot of careful negotiations and planning, and trying to design a derivative allocation or derivative offering for pension funds such that you do not expose the funds to too much risk. I think that is very important. But speaking to how you can use derivatives to enhance portfolio management for pension funds, I think Laura and Klaus have touched on the benefits. It's no different from what we do. We are all fund managers. But of course, given the fact that a large part of pension funds are exposed to fixed income, an instrument or a product such as the bond futures derivatives would be very, very helpful for pension funds to help us express views in the market and hedge against market downsides. I think that is very, very key as well. You did mention about some of the challenges with having to implement this and what the back office operations will look like. I don't think that would be a problem, because today we hold assets that are fair valued. Yes, if you go into derivatives, you begin to deal with things such as margin calls, but I think with an understanding of how markets work and in conjunction with our custodians, that can easily be dealt with in learning how to value the assets and how to make provisions if such margin calls do come to place. I think the industry is well equipped to be able to deal with the back end operations issues when it comes to derivatives. But what is most important is that I think for a start, if we are going to consider a product like this, there needs to be some constraints into how much PFAs, how much derivative exposures PFAs will be able to have, because at the end of the day, these are people's retirement monies. You don't want to open up these funds to a lot of volatility and exposure to risk. Maybe I'll just leave it there. Thank you. Thanks,
Babina, for giving more color to the issue. So I'd like to ask the last question, ask Laura the last question, because we are running out of time. So Laura, based on where you sit, I'm gathering that you have access to a lot of other asset managers, and there is some sort of proximity to the Fund Managers Association of Nigeria. So in this regard, I would like to just get your view on, I know others have spoken about it, but your own view as an asset manager or as a portfolio manager, how best you think the adoption of exchange traded products, how do you think they can impact the asset management space and more broadly the economy?
Okay, thanks, Fola. You know, when I think of, I guess, my response to the last question and all that's been said so far, especially when Babina was speaking earlier, you know, and extending it, you know, derivatives allow managers to do two things. One, you know, protect your portfolio or leverage your portfolios, as the case may be. And so it allows you really have more control over the outcome of your portfolio. So Babina spoke about derivatives, for example, ultimately leading to increased market liquidity. That's good for everybody. He spoke about derivatives allowing you to hedge your risk, because right now we don't have a lot of instruments available to hedge risk. Again, that deepens the market when you're able to hedge risk more effectively. Now, when I think of exchange traded derivatives, you know, when Babina was speaking, when Klaus was speaking earlier, he spoke about two kinds of derivatives. So it's either over the counter or exchange traded. Now, over the counter, you can build all kinds of, you know, you can combine all sorts of things, to be honest, to create as complex or as simple an exposure as you want. And that's usually very good, I think, for institutional or knowledgeable players who want to create or hedge complex exposures, right? Now, what exchange traded derivatives do is that it really brings it to a more standardized market. So these are standard instruments, standard contracts. Klaus talked about these versions really eliminating counterparty risk, because your counterparty in this case is the exchange itself. So you have a clearinghouse, for example. He talked about these instruments being marked to market daily, meaning that you can see your true position every day. And that's part of what Babina was referencing when he spoke about the fact they wouldn't have that really, because we're used to holding marked to market instruments, you know, there are really no issues on that side. And so these exchange traded derivatives, I think, make it very easy for managers to sort of dip their toes into the derivatives market, and it encourages participation. So I think everything we've talked about, to be honest, shows that in the asset management space, derivatives give you flexibility, and that is something that I think all managers will appreciate. But, you know, when you extend this to the wider economy, I think that derivatives give people the ability, the freedom, I think, to take risk. So frankly, the availability of risk management tools, of hedging tools, of insurance, right, allows economic players to take calculated risks. So if I use this here as an example again, when you think about how far and how fast commodity prices have moved, imagine you were a factory. You were, you know, an employer of labor in this economy. You were an entrepreneur. You know, imagine that you were able to enter a contract in advance that secured your raw materials. Imagine that you need raw materials like diesel or, you know, other food commodities, you know, whatever it is, these items that are vital in your production process. Imagine that you were able to secure the price in advance. And to be honest, it doesn't really matter if the price was high or low. You're able to secure a price in advance. What that allows you to do as a company is plan your production. You can plan your operations, and you can almost completely look away from the global market volatility. When Dr. Peter was speaking, he spoke about, we've had COVID, and then now we're with the Russia-Ukraine crisis. I mean, there is like one crisis after another. There are so many things that are affecting outcomes. And so allowing people create, control their environment allows them the freedom to then take risk. And that is really what derivatives do. So when you think of the economy, having that insurance, enables risk taking. And to be honest, to my mind, that leads to higher economic activity. And this point, to be honest, applies across industries. So for example, if a bank was able to hedge against interest rate movements with derivatives, it might give them more confidence to lend, more confidence to promote economic activity, and so on. So these instruments, when Klaus was speaking, I think I'll paraphrase at this point, he spoke about derivatives improving liquidity. He spoke about derivatives making the pricing of the underlying asset more transparent and economically correct. He spoke about derivatives being a hedge. And these benefits are frankly economically powerful, to be honest, and they help build a robust economy. And I think until we have these types of instruments, until we allow or create a market that allows entrepreneurs, companies, individuals, just name a sector, until we create an economy that allows them to have instruments that can hedge their risk, that can help them to create the kind of exposures that they want, we might not see the kind of growth that we're looking for. So these instruments really help multiply growth because they give certainty, and certainty allows planning, and planning is really what takes us from sort of point A to point B in the most effective manner. And I think that is what derivatives are there for, and that's the benefit that they can give our economy, if we get it right. And I think I'll just at this point lend, a little bit of, I think, credence to what Dr. Peter said earlier when he spoke about one of the things that we can do to ensure that these instruments are as effective as possible is take some time to find the markets or the exposures that investors are keen to either be exposed to or to protect against, and develop derivatives around those instruments or those markets or those assets so that participation is high. So Pavena spoke about, for example, being the fixed income market being perhaps the largest exposure that they have. And so focusing on that market to ensure that we have the right kind of derivatives is important to ensure that these instruments become commonplace. So yes, it's important to have derivatives, but I think having the right kind is perhaps a lesson that we can draw from the experience in Kenya to ensure that, in Nigeria, this takes off, and this takes off in a big way. Thank you.
Thanks, Laura. I particularly liked your last set of comments on how derivatives impact the economy, because it helps to start the conversation with the average Nigerian who would ask, what's the essence of this? So I guess I love the way you explained it in a way that, even a 5-year-old would understand. So thank you for that. And I would like to apologize to everybody. I mentioned Laura's name wrongly. Her name is Laura Fisayo Kolawole, not Laura Fisayo Kayode. So apologies for that. And I guess we can end on that note and go over to the Q&A session. And I would like to stay on Laura with this, giving her comments on the economy. So I'd like to go back to Patrick's question, where he asked about the wandering nature / high uncertainty of the Nigerian economy and what best strategy can the futures trader adopt. So if you could just help with that question.
Thank you, Patrick. I think that what I would say is because of how varied derivatives are, it really depends on who you are and what you're trying to protect against. As I said, if you were, say, a company that used wheat as a raw material, you might find that being very active in the wheat market and buying various, whether wheat futures, with different maturity dates at different prices over time might be something that would help you, particularly hedge your exposure. So it really depends. I think the first step will be to ask yourself, what am I trying to achieve? If I'm trying to protect myself against rising crude oil prices, then can I use oil futures as a way to ensure that I can buy oil at a particular price that I set today, and I can buy that in 6 months' time? If I'm trying to protect myself against falling equity prices, then do I want to sell a future or do I want to buy a put? As the case may be, depending on, I guess, how much money you want to put out at the start of the transaction. Do I want to use that as a way to ensure that even if prices fall, I feel protected because I already have a buyer at a particular level for the equities that I hold? So at this point, I'm not worried that prices are falling because I already have, downside protection. So it really depends on what you're trying to protect. Unfortunately, there are so many things that are going in so many directions. There are so many factors, and obviously, the one thing about markets is it takes two to make a market. So where there's a buyer, there's a seller, right? So it really depends on where you are and what you're trying to protect against. But you want to ask yourself, first of all, what exposure am I trying to protect against? What is the thing that I'm trying to achieve? And then what transactions can I put in place to get me there? And maybe you can update your question, I think, with exactly where you are, or what is it trying to achieve? Because when you use Nigeria, there are so many factors. You might be trying to mitigate against high crude oil prices. You might try to mitigate against high food prices. It might be that actually you are a seller of food, so you actually prefer if prices are high. So you're trying to, protect yourself if prices suddenly fall tomorrow, and you have built your whole model on yam prices being 2,000 naira, and then all of a sudden they fall to 1,000 naira. So maybe you're trying to mitigate against that, right? So it really depends on where you are. But the main thing is that just find out where you are, what you're trying to achieve, and derivatives can help you there.
Thanks, Laura. So I'll move over to the next set of questions. We have a hand up, but I would like Pabina to take a question before we allow Olubukola Afolabi to ask her questions. But first of all, I think Dr. Peter has answered the first question from Emeka, so I'm just going to move on to the next one and direct this question to Pabina. So how do you use derivatives to ensure that portfolios do not lose value? Over to you, Pabina.
Okay, I believe that's Emeka's question, if I'm correct.
Yes.
Dr. Peter has touched on some of that. But I think the important thing, some people, when they hear risk, people only think of the downside, right? But risk really borders on the variability of outcomes. I think that is what one should really focus on. And if you're looking at introducing derivatives into a portfolio, yes, you can use it to hedge downside. You can also use it to speculate. So that gives you that introduces a lot more volatility in the mix here. So I think that is where the risk comes in here. So speaking to how you use derivatives to hedge downside, I think Laura spoke to that earlier. And whatever position you're taking is always based on a view for a start. I have a view that interest rates are going to go up. So what it means that I need to protect my portfolios from the impact of rising interest rates. And then I can take a derivative that allows me to protect portfolio, to protect interest rates movements. You could also have a situation whereby, for example, I have a view that the stock market is going to rise, for example. So I can take a derivative that allows me to gain exposure to the market such that when prices go up, I can make that multiple gains. That you remember, derivatives gives you an opportunity to be able to leverage. So if I'm leveraging, what it means that I can free up capital to do other things. So that can be quite useful as well, because I'm putting down just a fraction of the contract value and gaining the full exposure I would get if I was holding that full position. I think it brings a lot of value, and the remaining bit of what I would have put into the underlying, if I was gaining the full exposure, I can use it, like Klaus mentioned earlier, to buy a risk-free instrument or seek other investments. That is the way you enhance the value from having exposure to derivatives.
Thank you, Pabina. So I would invite Olubukola to ask her question. So let me, if you could unmute. So Olubukola, if you could unmute your line and ask a question, please. Thank you.
Okay. Good afternoon, everyone. It's a he, actually. I don't know. I get this every time when people see my name. But it's okay. It's okay. Yeah. Thanks a lot. I mean, I'm an enthusiast. Anytime I hear derivatives, I get enthusiastic, and I just want to speak. So I'm hoping to make a lot of money from this instrument somewhere down the line. But I also don't want to get my fingers burnt. So part of what I'm doing now is to just have a lot of knowledge. Laura spoke about the fact that there's a cost attached to you trying to maybe protect the downside. But I'm also aware that you can go into combinations, and this is the basis for my question. You can look at, okay, who is if I'm bearish, do I have people who are bullish, and can I use that opportunity to almost maybe achieve maybe zero cost at the end of the day, when you go long, you go short in the other direction, and then you have something which is almost negligible cost to you at the end of the day. So my question really is it truly, from your experience, is it truly realistic to find markets going in these two directions, in which case where you think that a particular commodity is going to fall in price, and then you're trying to manage your hedging cost by also selling to people who think it's going to rise in price. So I mean, call and put at the same time. So what's the practicality of it? I think that's really my question. How practical do we think it is to be able to achieve this strategy, from your experience in the market? Thank you.
Thanks. So if I hear you, you're asking about essentially buying, did you say selling a call and buying a put? Was that what I heard? Hello?
So Olubukola, are you there? I'm guessing
okay. I just wanted to clarify that, but I think essentially you can put on as many option transactions as you like, or derivative transactions as you like, to be honest. So, you can choose to sell a call and buy
sorry, I'm back. Laura, yes, exactly what I was trying to say. When you buy a put to protect the downside, yeah. If there are people who have opposing view to yours, you think who are bullish, so they are willing to take the risk on the other side, in which case they think it's going to rise. So you can, like you said, you can sell a call. So you bring money, and if you are lucky to find a balance, you can almost achieve the hedging at near zero cost. So my question is, how realistic is that arrangement? Do we often have people? I mean, if I'm bearish on a particular product, is it normal to look in the market and find people who are, thinking about the other side? And how often do we have this experience? That's really my question.
Okay. Yeah, so in our market, right, obviously the derivative market is not as vibrant, right, as you have in overseas markets. But what you're talking about is, I think, very common. So you sell a call, you buy a put, and you use that to create, to one, earn the income, right? Because you're if you're the seller of the call, then the buyer will pay you the premium. So that's a little bit of income, right? But obviously your potential loss is unlimited because you are obligated to buy the instrument, right? And you can then buy a put, I guess, to also protect yourself. But so yes, you can combine, I think, as much as you want. But in our own market, the exchange, so on the NGX currently, they are working on, and I believe, have started to an extent, their derivative transactions. I think you can now trade futures on the exchange, or at the very least, they're very close. So if you look on their website, you'll find that there's certain lots of material about how you can onboard and become a market participant within the NGX market. I think they have on there the requirements for around things like capital adequacy or risk management and things that have to be in place for you to become a participant in the derivatives market on the NGX. And so if you join the NGX and you trade on there, when they actually start their activity, yes, you can, combine derivative transactions as, in any way that you like. And as you say, hedge yourself by selling a call and buying a put. So it makes sense. I think the main thing that derivatives does for everyone is it just shows that it takes two to make a market. So you're right. If you think that the asset price is going to fall, you just need to find somebody else who thinks it's going to rise. And right there, you can enter into sort of a bilateral contract with them, theoretically, right, to get the exposure, the derivative you're looking for. And that is where you have what they call over-the-counter contracts, where it really is just you and the counterparty, and you have sat down and you've decided, okay, you think it's going to fall, I think it's going to rise. Let us agree and let's enter into our contract. So that's on that side, you can enter into as many contracts as you like with various counterparties. I think the risk that comes out, so the reason why developed markets, I guess, went down the exchange rate traded route as well, is because you have lots of counterparty risk. So it's possible that you enter a contract with somebody and that person at maturity is not available to fulfill, or they've gone bankrupt or something like that. You then have issues with default risk. And so that's where exchange traded versions come in. But to be honest, I think that our market is still nascent, so I don't know that you can put together, as many combinations as you like. We're still building up. The NGX is still building up the market, but ultimately, it will get there.
Thank you, Laura. And thanks, Babina and Peter, for helping with the questions in the chat. I mean, that's helped to manage time. Unfortunately, we are actually out of time and we cannot take any questions at the moment. I see someone's hands is up, but we can't take any question. If you would like to ask further questions, my colleague Gloria would leave an email address in the chat box. You can direct your questions and we'll make sure that the answers get to you. So just leave your email address and obviously just put your questions, send your questions via email, and the answers will be sent to you. Thank you, everyone, and I'd like to thank the panelists for their wealth of information. So ladies and gentlemen, this concludes the panel discussion, and at this point I would like to invite our president at the CFA Society, Ibukun Oyedeji, to provide the closing remarks. Thank you.
Thank you very much for that. Can you all see me? Good afternoon, everyone, and thank you so much for attending this event. I was meant to actually take the opening remarks, but Nigerian style, I literally just got a flight, and you know how delayed the flights can be. So I apologize for that, but I have to say a very big thank you to the panelists. I have to say a big thank you to Claude from the CFA Institute for offering and willing to engage and participate in this discussion in the market. And also for each of the panelists that have actually been contributing. I dialed in as we were still having the conversation, and contributing and really having a very interesting conversation around exchange traded funds, which is really where we need to be as a market around derivatives. If we want to deepen our markets, we know that's the next stage we need to, and how much we have to contribute to that. So it all depends on all of us in the market. So thank you very much, Mr. Yinkere. Thank you, Laura. You are our member. So thank you, Laura, for contributing. Dr. Peter Onyango, please permit me if I don't pronounce it properly. Thank you so much for actually accepting to actually be a panelist on this conversation for us. I hope every single participant on this has found it very beneficial. I picked a few things. I think the put and call exciting conversations was going on. And I think the next stage for all of us is to see how well we can now carry what we've learned today forward into our various roles, and even see how well we actually further deepen our markets. Please look out for more engagements. But before I round up, a big thank you to Fola, the moderator. He's also a CFA chat. I shouldn't be thanking him, but thank you still. But thank you everyone for dialing in. Now, please look at our next event, and that will be coordinating. I wish you all a successful rest of the day. But thank you for dialing in. Apologies that I couldn't make it earlier. Thank you. Have a lovely day, everyone.
Yeah, thank you.
If you've made a decision to aim for a long-term and successful finance career, taking the Chartered Financial Analyst CFA exam and studying the curriculum is an excellent way to ensure you have a strong knowledge base and top-notch skills. Are you ready to take the bold step to invest in yourself? CFA Society Nigeria is at your disposal, promoting the highest standards of investment practice in Nigeria. As an affiliate of CFA Institute, CFA Society Nigeria seeks to promote the highest standards of investment practice in Nigeria and to provide a vibrant community in which its members and other key players in the investment industry can interact and grow. When you have the CFA Charter, you're globally recognized. Take advantage today by writing the CFA exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietyn.org. CFA Society Nigeria, making finance a force for good.